Welcome back, you legends. I'm Dr. Cal. Let's get right into it. So the stock market today closed about a half percentage point up on the S&P 500, 1.5% up on the Nasdaq, and the Dow closed basically flat. Taking a look at the stock market map, we can see again weakness in healthcare, defensives, and utilities. So we're seeing weakness in the defensive sectors of the stock market, and we're seeing strength in technology, communication services, entertainment, and consumer cyclical stocks, as well as energy. Looking at the different sectors, technology was leading the day, up 2%. Communication services and cyclicals up 1.4%, industrials 0.7%, and energy 0.6%. Financials and basic materials almost flat on the day. Real estate, consumer defensive down about half a percentage point. Healthcare down 0.8%, and utilities leading the laggards down 1%. Now, in terms of year-to-date performance, guys, utilities is actually one of the strongest sectors, energy being the strongest, and utilities coming in second place, consumer defensive coming in third. So this is a bit of a shift, right, guys, towards riskier assets, riskier parts of the stock market, technology, communication services, cyclicals. These are riskier sectors of the market. And we tend to see, guys, expansion in the risk appetite around earnings seasons. We see this all the time. Now, let's take a look at the daily chart for the S&P 500. We had another green candle today. We are inching our way forward into closing this gap at the $400 level at 401.7 exactly. Now we're about 5 trading sessions away from the Fed meeting on July the 27th. Again, as I said in the last video, I favor the idea that we will chop around, fill this gap, and then perhaps, guys, enter July 27th sitting at this resistance level. We could see another pop to the upside, hitting the upper edge of this channel. This is a possibility. It's not a guarantee, depending on what the Fed does. If the Fed raises interest rates by 75 basis points or less than that, that might be perceived as a positive sign and could send the stock market rallying in the short term, not long term. I still think long term we are very, very bearish, in my opinion. On the triple Qs, we already filled that gap yesterday. Now we're moving closer and closer towards the upper edge of this descending channel. Last time we touched this channel was right here back in April, beginning of April, which was a very similar time to right now because we had earnings come out just around then, and we have earnings come out right now. I have this red resistance line. This is a pivot point for the stock market. This is probably the highest the Nasdaq could go in the short term before selling back down. Now, I do trust this descending channel. This descending channel has been perfect. We've been trading within this channel perfectly, right? We've been touching the lower edges of the channel and then bouncing back up, right? So this channel has been trading perfectly for us, and again we saw selling when we touch the upper edge of the channel. So if we do touch the upper edge of the channel, that would be an amazing opportunity to load up on puts, in my opinion, for the Nasdaq. But personally, I would favor shorting the S&P 500 rather than the triple Qs, because I think there's been a shift, a paradigm shift underneath the market where growth stocks are starting to outperform value stocks again, and the Nasdaq has been starting to outperform the S&P 500. In fact, I'll show you this on the chart. Let's take a look at the weekly chart, guys. Right, we hit the 200 weekly moving average and we've been bouncing up. So we could just see some choppiness around this range. What could completely change the face of the market is if we actually break below this 200 weekly moving average and then stay below, and then start seeing the 200 weekly moving average curl down. For decades now, we've seen the triple Qs and the S&P 500 respect this ratio, right? The Nasdaq has been outperforming the S&P 500 continuously for over a decade now, right? Every single time we touch the 200 weekly moving average, we saw bounces, okay? It is a possibility, guys. This could change. We've seen this paradigm shift back in the 2000s after the internet bubble burst. So that is still a possibility. It could happen, guys, okay? But in the medium term, in the short term, looking out into September, October, I still favor, in my opinion, shorting the S&P 500 versus the triple Qs. Now let's take a look at the VIX. Today the VIX put in a lower low, okay? So there's a very strong chance now that we will put in another signal just like this one. Okay, we might doodle around here towards the lower edge of this upwards channel on the VIX. If we end up touching the lower edge of this channel right here, that would be the perfect spot Again, buy puts on the triple Qs and the S&P 500. Now, if we do end up seeing the VIX touch the lower edge of its ascending channel, and then we see the triple Qs hitting the upper edge of their descending channel and the S&P 500 as well hitting its upper edge, that would form an amalgamation of different technical signals to sell out of the market. That would just make it a much stronger sell signal. I would tend to look more at the Nasdaq, because the Nasdaq has been respecting its channel a lot more than the S&P 500. We've seen breaks out of the channel with the S&P 500. We haven't seen that with the triple Qs. I might need to make some small adjustments to the S&P 500 channel. I just need to see the local top being put in, and then after we start selling off, I'll adjust the channel to hit the upper edge of that final rally that we will get. Okay, let's take a look at the DXY, the dollar index. The dollar index has actually started to bounce at a very critical level. Look at that. This is the 20-day moving average, and the last time we saw the dollar index bounce off of this level, we've seen significant buying in the dollar index. So if we start seeing the dollar index start moving up, and then we start seeing the S&P 500 stagnate at these levels here, that would again be another strong sell signal. So a lot of things, guys, are aligning towards the bearish side. We're getting much closer to that perfect entry. In terms of the MACD, the momentum, I'd be looking at the 4-hour chart for a bearish crossover. That would be another signal to look at. Now let's take a look at the 10-year yield. The 10-year yield has actually paused at these levels. If we start seeing the 10-year yield curl back down and break this low, that would be a positive sign for the stock market. If we see a break above this level here, 3.1, that would be a bearish sign for the stock market. Let's take a look at the SMH, the semiconductor index. Look at that. So I've drawn this resistance channel earlier this year, and every single time we've touched this channel or we got inside of the channel, we saw significant selling follow. So this will be no different. I expect some little chop here as NVIDIA closes this gap and maybe moves up slightly toward the pivot point of $184. And as we see AMD close its gap right here at $95 and hit the upper edge of this channel. Again, AMD has been one of the best stocks in terms of respecting its descending channel, right? Every single time we've seen a touch of the upper edge, we've seen selling. Every time we've seen a touch of the lower edge, we've seen buying. So this channel has been working perfectly for us. I did enter AMD exactly on July the 5th, right as we made that bottom. I got lucky, I guess. I rode it until we hit that $80 level. I sold right here. I never got back in, unfortunately. I decided to be more conservative and just take profits here, and that position actually ended up making a 300% profit. But I did make a nice profit, so I'm happy. Now let's take a look at Apple. Apple is looking like it wants to start pivoting, start chopping at this level right here. We are inside of this resistance box, this pivot box, right? It acted as support back here and then acted as resistance after we broke through. So again, we're getting really close to the upper edge of this channel again. And if we hit that upper edge of the channel as Apple reports earnings and as that FOMC meeting is out of the way, that would be, in my opinion, an amazing entry point for a short position. I've already opened a short position right here. I will be looking to add to that short position in the next few trading sessions. Now let's take a look at Tesla. Again, Tesla has been coiling inside of this wedge. Tesla did report today after the market close. It missed on revenue, it beat on EPS, it missed on profit margins. So it's a bit of a mixed bag. I tend to believe that the earnings report is more bearish than bullish, in my opinion. That's what I've read into it. We could still see a Tesla rally even after this mixed report. The possibility of a rally is still open because we're still seeing strength in the stock market. But as soon as the Qs hit the upper edge of the descending channel, as soon as the S&P 500 does the same, I would exit out of Tesla, okay? And if that happens to be where Tesla hits this level right here at 850, and then this S&P 500 hits its upper edge, same thing with the Qs, that would be the perfect spot to take profits if you are long Tesla and perhaps switch to being bearish. Now, I want to bring up seasonality again. We are right here. In terms of midterm years, we do tend to see a little bit of a rally towards the beginning of August, end of July. So it is still possible to see some bullishness even after that Fed report, but I'll be looking at the technicals to make a decision at this point, to be honest. I will not be relying 100% on seasonality. I'll be more looking at those targets, those channel resistance levels, all of that stuff. A bearish crossover on the MACD, things like that, okay? Now, I do want to show you this fear and greed index by CNN, guys. We've jumped significantly from extreme fear towards fear. We're still moving up. We might hit neutral, even greed. And now the fear and greed index, guys, is based on 7 different indicators. One of those critical indicators is stock's price strength. This is basically based on the net 52-week highs and lows, and we are sitting at extreme greed. Another one that is starting to point towards the greed rather than the fear is the put and call options. We also have volatility continuing to tick down. Safe haven demand is declining, so a lot of these indicators are starting to turn from fearful to greedy, and that's actually a bearish sign, not a bullish sign, okay? You want to sell into greed and buy into fear, okay? That's how you would use this indicator, and it's been one of the best indicators in terms of that. I am still looking at the stock price breadth. So the breadth, guys, is a measurement of how many stocks out of the entire stock market are moving up or moving down. So it's based on quantity, okay? When in contrast, the S&P 500, for example, is based only on 500 stocks. So it's not a good indicator for breadth. For a full market recovery, we need breadth to move up. We need a very strong upward movement in breadth, just like we saw back here towards the end of March, beginning of April. So this rally is very, very sus. It's very suspect in my opinion because we haven't seen breadth move up. That's just another thing to look at that is pointing towards the bearish side. Now, how important this indicator is, in my opinion, it's critically important. Why? Because we've seen breadth absolutely collapse from the middle of 2021 towards November of 2021, months ahead of that massive crash that we had in January. So it is a leading indicator when you see breadth collapse and stocks still moving up, the S&P 500 still moving up. That's a very weak rally. It's a very shallow rally, only led by a few stocks rather than the entire market. In terms of earnings, guys, tomorrow we have Snap, we have Dow and Nucor, as well as American Airlines. Now, in terms of earnings, guys, exactly as we expected, ASML did well. It beat slightly on profitability and revenues. United Airlines missed on both, and then Tesla had that mixed report, in my opinion, leaning more bearish than bullish. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow!